Welcome to TheoTrade. This is Don Kaufman. Here we are. It's March 8th, 2017. We've got just about 6 minutes left to play in today's trading session with the S&Ps now tracking lower. I say now tracking lower because earlier in the trading day, of course, the S&Ps were up in the 2373 handle. There's actually quite a bit going on in today's session. It feels a little slow, but let me get right down to a couple of very key points for the market moving forward this week. Okay, this of course being Wednesday, Thursday, Friday, what can we really expect? So as I said, the S&Ps right now are down 5. Volume has actually picked up quite substantially since the selling really kicked in here. And when did it really kick in? Again, late in the trading day. Here we are with just 5 minutes to go. And as I said, some of the volume really picked up. We've been substantiating over 5,000 contracts per minute. But neither here nor there. What does this do for us on the S&Ps on a little bit of a longer time duration here? And that is, hey, what is this? I'm starting to see some sell-side activity. Yes, we're starting to see some sell-side activity, but volume overall, again, it hasn't really picked up to the downside. Now you can see a line drawn on my chart that happens to be 2349. Just keep it in mind, if we had hit 2349 anytime in the next few trading sessions, you can see some fireworks go off. Okay, so there's again a little bit of a broader look at the S&Ps. I also want to take a quick glance over at the Russell with you, as the Russell has become a bit more of a slippery slope over here. Now, my single largest position currently is short in the Russell product, which would stand the most to lose if the markets were to take a tumble. However, back up for just a moment over here. There's one very key point to be made, okay, this week. It's where the SPX is sitting. So let's divert a little bit away. We'll divert our attention away from the S&P futures, and we're going to start looking at the SPX. The SPX, it's sitting on the edge of the expected move for the entire week. Now, I've talked about the expected move quite extensively, and I'm going to take you through a little bit of this week's expected move. How I'm going to do that, again, I say we're sitting on the edge of the expected move, but let's go back and actually review what that number is. To do that, I'm going to go in here to the Analyze tab on thinkorswim, and I do this quite frequently. It's just a quick glance back at previous trading days, and in this case, I'm taking us back to March 5th over here. Why? It's Sunday. Okay. It was a nice, lovely day. And I want to look out at the entire week. And when I say I want to look at the week, all right, I'm looking at this week. And I want you to realize on Sunday, the expected move, and again, I'm going to highlight this on your screen. The expected move for the entire week was just shy of 20 bucks, but call it 20 bucks. Look at where we were, though, on Sunday. Markets open on Monday morning. We're 23.83, exactly $20 lower takes us, right? Okay, ultimately where we currently are, which is 23.63. So we've dropped to the edge of the expected move. Now, this is something that I mentioned. Okay, the precise idea was mentioned last week. Last week, though, okay, and I'm just going to take you back over here. Last week, we did the exact opposite. Last week, we actually breached the upper end of the expected move. And the moment we actually hit it, we came off pretty fast and furious. Now, what does the edge of the expected move really mean for you? Like, put that down into terms that, you can understand over here. It's very simple. Do not look at this per se as support and resistance. And again, the level that we're referencing is literally the level that we're currently sitting at. And that level happens to be right here, 23.63 on the button. That's exactly where we're sitting. Look at it almost as a two-way door over here. If the S&Ps, okay, are to really breach just slightly lower, now slightly lower, if they cruise down about 5 or 10 points from here, there could be an immense amount of sell-side activity that will come in. Okay, why? Because of hedging activity. All right, these big trading firms all use these expected moves to reduce risk. That means they have a tremendous amount of risk if we cruise outside of that 20-point window. So if we actually get just, again, 5-10 points below the expected move, you could have some real sell-side activity come in. The interesting thing, though, is in recent trading sessions, even with all these explosive up moves, we have still closed inside of the expected move almost every single week, okay, in recent history. The last time we really blew through the expected move, you have to go back to December 7th, okay? That's that big, huge up day. December 7th, we actually blew through the expected move in this particular week. This was actually a Wednesday right here. In this week, we ultimately had a 3 sigma move, which is 3 times the expected move. So the point that I'm making right now is just a very, very simple one, okay? If we continue below the expected move, we could drop 40 points in the S&Ps like nothing, because we haven't seen any 2 sigma moves lately. All we've seen is move inside of expected, move inside of expected, move inside of expected, boom, 3 sigma, which is a 3 deviation move, okay? It's likely implausible that this could occur. Now, you got to look for catalysts, right? Well, guess what? This Friday, there's a jobs report, okay? However, there's the closing bell. However, the irony is that we're literally closing directly on the expected move. And I talked about this over the weekend, and I talked about this, of course, on Monday as well. Now, I'll move on from there, okay? So, again, if we cruise below this 2363 that we closed at, ultimately, okay, the door could be wide open for sell-side activity. However, you know, what's more likely? Exploding to the downside or reverting back up? And the answer is reverting back up is a much more plausible scenario at this point. Now, I'll switch gears on you here for a moment. Again, we have the jobs report coming out on Friday, but something interesting happened this morning and something I haven't seen in a very, very long time. This morning, we had the ADP report. What is the ADP report? Like, nobody even knows what the ADP report is. It's kind of like a pseudo jobs report, and there it is. And it had a massive influence in the bond market. Okay, so the market really is taking these jobs numbers to heart. Okay, at this point, again, the ADP report really influenced the bonds. The bonds sold off. The weird thing about the bonds selling off right now, so let's make sure everybody's aware. As the bond market sells off, let's take a look at the bond market. The bond market is sold off. Okay, we're approaching some of the recent lows over here. As the bond market sells off, if you take a look at TNX, it's the interest rate. Now, the interest rate and the TNX is associated with the 10-year, but as bonds sell off, the interest rates go higher. All right, so here we have interest rates ultimately, boom, going higher at that point. Okay, so what's the problem? Interest rates are going higher. I don't know if you guys remember, but like a year ago, there was what they called the taper tantrum. The threat, okay, of tapering or the threat of interest rates going higher was going to be the ugliest thing ever for the markets. How the narrative has completely changed. How come now all of a sudden higher interest rates are good for the world? Whereas, again, in recent history, higher rates have actually meant what? Well, slower economy. Aren't they raising rates to actually cool the economy? Isn't the idea of the Fed to raise rates to cool the economy? No, again, the impact of the Fed would never be immediate. Okay? But the market, all of a sudden, again, it's all about what people want to hear. Okay, and what people have to hear to keep the market ultimately, you know what, at the valuation of 2363 where it currently is. And you think about this, and again, you need to step back from all the garbage that you hear on a day-to-day basis and recognize that if we're going to really be in a rising interest rate environment, all right, that is to cool the economy. And you're like, okay, but you know what, rising rates, I think it can help financials to a point. Sure. Can help financials. Is it going to help consumers? You know, which is, of course, about 2/3 of the entire economy out there. And the answer is absolutely not. Is it going to help you buy a car? Probably not. Is it going to help you with a home loan? No, definitely not. Okay. We're in a rising rate environment over here. But again, we've now been led to believe that the rising rate environment is a good portion of the narrative to curb inflation out there. So again, it's what they want to hear on any given day. Think about that, though, raising the rates. And we've had a quick jump now from almost 2.3% in the 10-year to back to almost 2.6%. Okay. Once again, I want to switch gears on you a little bit from that narrative over specifically to the XLF. Because the XLF, once again, pretty interesting day inside of the XLF as it opened ripping higher this morning and faded the entire trading session, closing up massively unchanged on the day. The reason I'm pointing the XLF out specifically, okay, the financials, it's what's holding this rally together. This is the last bastion of hope in this rally over here. We're watching it carefully. You know, I'm not ready to call this is it, we're going to sell off. Not ready to call that yet because I think it'd be foolish to do so, okay? But we are actually teetering on the edge. We're teetering on the edge of an expected move. We could see some sell side activity come in over here. We have a prime time catalyst, which is the jobs number coming out Friday. Again, a couple of the planets aligned. The most important thing for you right now, you better watch your risk. Again, got to know your risk. We're on the edge of that expected move. The most likely probability is that we revert back up. All right, meaning that the S&Ps actually revert back to the upside after a little sell side activity. However, okay, I believe that any rally could be rather short-lived at this point. Markets are slipping, but they're slipping on relatively low volume. I've even noticed again that the option volume was relatively light. However, on the flip side over here, if we break just ever so slightly lower, you'll see sellers finally spark to life. And specifically, okay, and we're only a few points off this, very specifically, right here, 23.49. Mark it on your screen, mark it in your head. We actually hit 23.49, and that's when heavy sell side activity would actually kind of rein into the market. So stay tuned. Much more coming up here at TheoTrade all throughout the course of this week. Have a great evening, everybody. Bye-bye.